Hello everyone and welcome back to the Blueprint Strategy. Congratulations on completing Module 1. My name is Tobias and I'm a mentor at Online Trading Campus. I'm excited to guide you through Module 2. By now, you should have a clear understanding of the assets we trade, Campus Fund platform, your trading journey, and the basics of trading mechanics. You have also learned the fundamentals of long and short positions, candlestick patterns, chart types, and timeframes. Every price chart shows filled orders in the form of candlesticks, transactions that have already occurred. However, what truly drives future price movement are unfilled orders, which remain invisible. Our aim is to locate areas on the chart where these institutional unfilled orders are most likely to exist. By identifying these zones where institutions are prepared to buy or sell, we can align our trades with theirs. This is a focus of Module 2, Supply and Demand Essential. Let's dive in. Module 2, Lesson 1, Supply and Demand Essentials. Welcome to the first chapter of Module 2. In this lesson, we will cover foundational concepts that are crucial for successful trading. By the end, you will understand where to buy and sell, how to identify high probability zones for entering and exiting trades, supply and demand, the core principle driving market movements and price action, types of formation, recognizing patterns that signal potential reversals or continuations, line placement, mastering precise placement of supply and demand levels to refine your trading accuracy. Let's begin by discussing the ideal spot to buy an asset. Where's the optimal spot to buy this asset? Take a look at this chart. The best place to have bought this stock is right here at the bottom. What do we know for sure about this point? It's where the price reached its lowest level and began attracting buyers. But why was this a turning point? At that moment, an influx of buyers entered the market, meaning more money flowed in than out, creating upward pressure that pushed the stock price higher. Why is this significant? And who are these buyers? The stock market operates on a massive scale, around $26 trillion, mostly split between two main groups: retail investors, individuals trading personal accounts, and institutional investors, hedge funds, pension funds, big banks, etc. Institutions dominate the market, accounting for over 90% of trading volume. Whenever you see a major price move, it's almost always driven by institutional money. This is where retail traders have an edge: agility. While institutions create the big waves, retail traders can move faster, jumping in and out of positions to profit from the momentum institutions generate. The flexibility allows us to capitalize on opportunities that emerge in the wake of institutional activity. Let's take a closer look at these two curves. You might recognize them from an economics class in university. On the left is a supply curve, which slopes upward as price increases, reflecting that suppliers are willing to provide more units at higher prices. On the right is the demand curve, which slopes downward as price increases, indicating that buyers become less eager to purchase as prices rise. When prices are low, demand is high because buyers see more value. Conversely, as prices climb, suppliers are motivated to produce more, while buyers start to pull back. For traders, the takeaway is straightforward: buy at lower prices where demand is strongest and sell at higher prices where supply is plentiful. In other words, buy low in demand and sell high in supply. This basic principle underlies almost every market transactions you will see on the chart. When we overlay the supply and demand curves on a single chart, three key areas emerge: equilibrium in the center, where the two lines overlap, supply excess above that point, and demand excess below it, We use these same zones when analyzing any price chart because they help determine our trading bias, whether to buy and sell or stay neutral. Here's the guiding principle. Trade in imbalances and stay out of equilibrium. If price is at equilibrium, the market is balanced, so we remain neutral. If price is in a supply zone, we sell. This area represents an imbalance where price tends to revert toward equilibrium, offering high probability and high profitability trades. If price is in a demand zone, we buy for the same reason. Price often rebalances from this lows. In a nutshell, we don't trade equilibrium. We focus on supply and demand imbalance, where price is most likely to turn and create profitable opportunities. Let's take a brief moment to recap what we have learned so far. We have established that market prices turn when supply and demand are out of balance, meaning one side effectively disappears at a certain price level. As traders, it's our job to identify those areas of imbalance, just like in the Warren Buffett example with IBM, where we spotted clear demand and supply zones. These imbalances reveal unfilled institutional orders, and the stronger the imbalance, the greater the number of these hidden orders likely awaiting execution. Ultimately, our goal is to discover these institutional orders in advance, so we can align our trades with the major market players, riding the waves they create. To make that happen, we need to keep two critical questions in mind. Where do market prices turn? And who is on the other side of our trades? Let's begin with the first step. Where do market prices turn? Looking at this section of the chart, prices are moving sideways. That suggests supply and demand are in balance. Neither side is dominating. Then all of a sudden, there's a steep drop. You might think, I can't wait to learn how to predict that. Or I want to profit when prices fall like this. However, our approach is different. We let price move away first, because only after price falls can we confirm that supply exceeded demand at the origin of the drop. The quick, decisive move away from that level is our proof of a supply-demand imbalance. Here's how we capture it. Wrap two lines, called the proximal and distal line, around the origin of the drop. Highlight that zone with a yellow box, for example. Carry it forward on our chart. This highlighted area becomes our supply zone. Next, look at the bottom of the chart. Prices are trading sideways again, and suddenly there's a sharp rally. After the rally takes off, we can now say with confidence that demand exceeded supply at the origin point. Just as before, we draw proximal and distal lines around the origin of the rally. Highlight that zone, carry it forward on the chart. This highlighted area is our demand zone or buy zone, revealing where the real willing buyers are. By making these zones, we can confidently say, here demand exceeds supply, or their supply exceeds demand. This is a core process we use to identify supply and demand imbalance, and thus potential turning points in any market. Next, let's figure out who's on the other side of our trades. Essentially, there are two types of traders: those who make money and those who are losing. There's hardly a middle ground. The losing group, often novice retail traders, tends to make two common mistakes, illustrated on this chart. First, they buy after a strong rally, driven by greed. They are chasing a market that's already climbed significantly, which is risky. Second, they buy right into a price zone where supply exceeds demand. When you purchase in an area with more willing sellers and buyers, you will lose over time. Instead of joining them, we want to be the sellers in that zone. And as expected, prices drop. On the right side of the chart, the same group of novice commits the opposite mistake, selling after a steep drop at a level we have identified as demand exceeding supply. That's precisely where we want to buy, placing a protective stop just below the zone. By following this approach, buying at the demand zone with clear set parameters, we often capture the lowest risk, highest reward, and highest probability trades in the market. This slide is especially helpful if you dabbled in support and resistance trading through books or free YouTube tutorials. If you've never heard of support and resistance, great. You can skip this part. But if you have, pay close attention, because what you're about to see illustrates why most retail traders who rely on support and resistance struggle to make consistent profit. It conflicts with the reality of supply and demand. Take this chart. For example, suppose we have a supply zone with around 9,000 unfilled sell orders. In real trading, we never know the exact numbers, but we will use this for demonstration. If price returns to that zone, it's logical to sell because we believe unfilled sell orders remain. Price does come back and then it drops, confirming our supply zone. Here's the key takeaway. Each time price returns, more of those unfilled sell orders become filled. So the number of unfilled orders decreases. As a result, the odds of another strong drop go down each time price revisits that same level. However, a typical support and resistance trader might only start to view this area as resistance, and after price touches it a second, third, or even fourth time, believing that the more times a level is tested, the stronger it becomes. This view suggests unfilled orders are somehow increasing, but in reality, they are diminishing with every test of that zone. And that's why conventional support and resistance logic often contradicts the true supply and demand dynamics. Now, let's discuss formations, focusing first on demand formations. There are two key patterns: drop, base, rally, DBR. This pattern starts with a drop in price, then moves into a base where the market stabilizes and becomes balanced. After this pause, the price rallies sharply to the upside, forming a shape similar to a U. The demand area is located in that base, which acts as the origin of the imbalance. Rally, base, rally, RBR. As the name suggests, the price initially rallies, then transitions into a sideways base, another period of balance, before launching into a second strong rally. Once again, the demand zone sits in the base where the market was momentarily balanced before pushing higher. Now, what do we do with these demand zones once we have identified them? How do we act in the market? Let's examine each formation individually, starting with a drop, base, rally, U-shape. After spotting this pattern, we pinpoint the base, the origin of the imbalance, then highlight that area and mark it with two lines. This is our demand zone, signifying where buy orders are likely clustered. When price returns to this zone, we aim to buy, expecting these unfilled orders to push price higher and away from the zone. Let's move on to the second demand formation. Rally, base, rally. Once identified, we highlight the base and draw two lines around it. When the price returns to this zone, we aim to buy at the origin of imbalance, always located within the base. This is a guiding principle for all demand zones. We want to buy where price previously stabilized before rallying. To show this in action, let's look at a practical, real-life example of demand formations. Welcome traders to our practical application. Today we will talk about demand formation, the drop-based rally and the rally-based rally. Let's go into the charts. Here we will using our Campus Fund trading platform. We will use it for execution and to analyze assets. By the way, it's TradingView. Now let's start with the first demand formation, the drop-based rally. I opened the S&P 500 on the daily chart, but you can use any asset and any time frame. And look at this. This is our drop, 2 basing candles and a rally, right? Let me highlight this for you. Our drop-based rally, or we call it U-shape, right? This is our formation. We can use it also for our entries and stop loss, means set. We are waiting here now for the pullback. That means price comes back into the zone. We will fill more institutional unfilled buying orders and then price will rising up again. Let me show you another example. It's the same asset and the same time frame here, but another formation. The drop-based rally is now located here. It's another one. And let me highlight this for you. You can see if we go from the left to the right, it's a drop, 2 basing candles, and then a huge rally, right? Now the idea is we will wait that price comes back into our zone. By the way, this could be our set, means this line, our entry, and we would move our stop loss below this line here. Price comes back into the zone, and then we will see a rally again. Let me press and play. You can see it's going up, right? But we are still waiting to fill more institutional buying orders here. And boom, you can see that here. We hit the zone again. We filled more institutional buying orders and then price rising up. Great. Now let's talk about the second formation. And this is our rally-based rally. Here, Euro-US dollar on the weekly chart. You can see a green candle, 2 basing candles, and another clear rally. I will highlight this for you. That's our rally-based rally. Same idea like the previous example. We are waiting that price comes back into the zone to fill more institutional buying orders and price should rising up again. Let me show you this in the next example. Euro-US dollar weekly time frame. And this is our clear rally-based rally, right? I will highlight this for you. And again, it's the same idea. We are waiting to fill more institutional buying orders. Let me press the play button. And then we will wait to getting filled. Price has to hit our entry line, right? And then price should rising up again. The reason is we filled more institutional unfilled buying orders. That's the idea. And you can see we are really close to it. We hit the zone and now price is rising up and rising up. That's perfect. That's exactly what we are looking for. Now you've seen the 2 different demand formations, the drop-based rally and the rally-based rally. Let's explore supply formation, which mirror demand formation, but are flipped. There are 2 primary types, rally-based drop, RBD, the inverted U. Price rallies, forms a base where it stabilizes in a balanced state, then drops sharply. This shape looks like an inverted U. The base marks the origin of the imbalance, which defines the supply zone. Drop, base, drop, DBD. Price initially drops, pauses in a sideways base, then continues to drop from that base. Once again, the base represents the origin of the imbalance, making it the supply zone. Let's look at how to act on the first supply formation, the inverted U-shape or rally-based drop. Once identified, we highlight the base, mark it with 2 lines, and extend them forward. Rather than chasing the initial drop, we prefer to sell when price returns to the origin of imbalance, which is the base. Finally, we have the drop-based drop formation. After spotting the supply zone, we highlight the origin, draw 2 lines around it, and extend them forward. When price returns to this area, our plan is to sell at the base of the formation. Let's move on to a real-life example of supply formation to see how this works in practice. Welcome, traders, to our practical application about supply formations. Today, we will talk about the rally-based drop and the drop-based drop. Let's go into the charts. We will use Campus Fund. That's our trading platform. And yes, it is TradingView. Let's go into the GBP Canadian dollar. And this is a daily chart. We are looking here for the rally-based drop. And look at this. Here we have a really nice rally-based drop. I will highlight this for you. The idea is that we expect there still institutional unfilled selling orders. Okay? Means we can use this zone for our set, our entry, and our stop loss above. We have to wait now that price rise up into the zone and then declines again. I will show you another example. This is a Euro Japanese yen on the daily time frame. And here there's another rally-based drop, an inverted U shape. That's how we call it. And I will highlight this for you again. That's a rally-based drop. And it is the same idea like before. I will press a play button and look what will happen. You can see the price here declines more. Now we hit our zone and declines again. That's great. Means we filled more and more institutional unfilled selling orders here and price declines. That's great. Now let's talk about the next supply formation. That is a drop-based drop. Here I prepared already an example. It's an Australian dollar, US dollar. And now on the monthly chart. And look at this. The monthly chart is very easy to identify this formation. There's a drop, base, drop. I will highlight this for you. Same idea. We're expecting there's still institutional unfilled selling orders, right? Let me show you this in the next example. Here we are on the US dollar Japanese yen monthly again. And look at this. At the top, there's a drop, there's a base and another drop. I will highlight this for you and then we'll press a play button and we will see what will happen. Look, price is close to our zone. Now we hit the zone and look at this. We'll fill more and more institutional unfilled selling orders. And price declines, declines, declines. That's great. I'll pause this now. Great, guys. That was our practical application about the drop-based drop and the rally-based drop. To wrap up this lesson, let's quickly review what we have learned. You now understand how supply and demand imbalances move price, how to identify those imbalances, and how to trade them. Here's a handy cheat sheet. Our demand formations are either a drop-based rally or a rally-based rally. We use them to buy when price returns to the base. Inversely, our supply formations are either a rally-based drop or a drop-based drop. We sell or short the asset when price returns to the base. To make it even more simple, buy in demand zones and sell in supply zones. This is our bread and butter. In the next lesson, we will focus on candles, their different shapes and what they reveal about institutional activities. See you in the next lesson.